Are you trapped in the same destructive cycles? Be honest, aren't you? You just liquidated another position prematurely. The setup was textbook. Your analysis was flawless. Your execution was sharp. But the second price retraced a mere 0.3%. Your hand gravitated toward the exit button as if possessed by an external force. Now you are forced to watch that same asset surge toward your predicted target, leaving you behind at the starting line. Here is the bitter reality. This isn't an isolated incident. It's not even the 10th time it's happened. It is a chronic loop you cannot seem to sever, and deep down you confront the truth. The market isn't obstructing your success. You are. This is self-sabotage. It is an internal virus that bankrupts more traders than any flawed strategy ever could. By the end of this discussion, you will possess the psychological tools to dismantle this. What most practitioners fail to grasp is this: 90% of trading failure is entirely unrelated to technical skill. A University of California study tracking 66,000 retail accounts revealed a staggering truth. The failing traders weren't utilizing inferior strategies. They weren't lacking in education. They weren't misinterpreting the charts. They were sabotaging themselves, strangling winners, nurturing losers, overtrading in moments of arrogance, and freezing in moments of fear. Does this resonate? If you have ever audited your journal and asked, "Why do I keep inflicting this upon myself?" understand that you are not alone. The difference between you and the 95% who surrender is that you are still here, still seeking the answer. You are finally ready to dissect what is actually occurring inside your mind during these moments of self-destruction. Once you diagnose the pathology, you can begin the cure. The mirror effect. Your performance is a direct reflection of your internal state. Let's address an uncomfortable reality. When you exited that winning trade too early, what was your genuine fear? Was it the financial loss, or the ego-shattering possibility of being proven wrong? When you clung to that losing trade until it decimated your capital, what were you truly anticipating? A recovery, or simply avoiding the admission of a mistake? The market does more than test your strategy. It strips away your mask and reveals your psyche. Every position you take is a reflection, and the image staring back isn't always pleasant. Research from MIT has illuminated a fascinating truth about the brain of a trader. When participants were forced to hold losing positions, their neurological activity mirrored that of a physical threat. Heart rates accelerated. Cortisol flooded their systems, a full fight-or-flight activation. Your biology interprets a red trade the same way it interprets an apex predator. This isn't a character flaw. It is an evolutionary defense mechanism. However, here is where the elite separate themselves from the crowd. Successful traders don't eradicate fear. They contextualize it. They recognize the pattern. They understand that the urge to flee isn't a protection of capital. It is a protection of a wounded ego. As one veteran remarked, "I realized I was exiting trades the same way I avoided conflict as a child. I retreated the moment discomfort arrived." Examine your last 5 losses. How many were genuinely bad strategies? And how many were solid setups that you mismanaged because you couldn't tolerate emotional tension? The market isn't your rival. It is your mirror. It will keep repeating the same lesson until you evolve to learn it. Stop resisting. If you continue to ignore these signals, the cycle will remain unbroken. The paradox of control. Why the harder you pull, the more you fail. It sounds counterintuitive, but the more you attempt to dominate your trades, the more you sabotage them. Traders often mistake discipline for sheer force, trying to suppress emotions or white-knuckle through the pain. Yet, research indicates this approach only guarantees a more violent emotional explosion later. Psychologists call this ironic process theory. The more you suppress a thought, the more dominant it becomes. Try not to think of a white elephant, and it immediately occupies your mind. The same applies here. Don't overtrade, don't overtrade. And after 3 losses, your suppressed impulses take the wheel and you overtrade. You must stop making this a war of willpower. It is self-defeating. Elite trading firms understood this long ago. They don't train traders to kill their emotions, they train them to observe them. Suppression is friction, observation is awareness. When you resist an emotion, you feed it. When you observe it objectively, you neutralize it. A trader at SMB Capital noted, "I stopped trying to hide my fear. I started acknowledging its presence. That tiny shift changed my world." By noticing the fear, you create a buffer, a space between the stimulus and your reaction. In that space, conscious choice is born, and in that space, self-sabotage dies. The winning streak trap. Success is the precursor to ruin. The most treacherous moment in your career isn't after a drawdown, it's immediately after a major victory. The University of Chicago found that traders are 34% more likely to take reckless, oversized risks following a winning streak. Why? Because profit feels like validation. It tricks you into believing you have mastered the market. Dopamine floods your brain, whispering a lethal lie, you are invincible. That is when you inflate your risk. That is when you take the mediocre setup you would have ignored yesterday. You abandon your rules because this time is different. The second you feel complacent is the second you must walk away from the screen. John Coates, a neuroscientist and former trader, discovered that winning traders have elevated testosterone. While that sounds positive, high testosterone drastically increases risk-taking behavior. It makes you play as if you are using house money. One trader summarized it. "My best days were the architects of my worst days. I'd win big, feel godlike, then incinerate it all the next morning on a revenge trade. The market doesn't punish you for losing. It punishes you for the arrogance of believing you've won." Shift your perspective. Become skeptical of your own confidence after a win. The version of you that exists after 3 profitable days is the version most likely to destroy your progress. As your wins accumulate, your vigilance must increase, not decrease. If you feel the onset of complacency, know that a catastrophe is lurking just around the corner. The phantom pattern, when your edge becomes your enemy. You develop a system, you backtest it. It works flawlessly for weeks, then suddenly it begins to fail. You panic. You manipulate the indicators. You switch time frames. You lose yourself in a maze of your own making. But here is the reality. Your strategy didn't fail. Your conviction did. Markets are dynamic. They trend. They range. They explode with volatility and they go stagnant. A system optimized for a trend will naturally struggle into consolidation. That isn't failure, it's the nature of the game. Most traders, stagnant, cannot endure this variance, so they sabotage their edge by constantly fixing it. The elite minority remains tethered to the plan even when the plan is temporarily out of sync. Professional traders don't ask, "Why isn't this working?" They ask, "Is my strategy currently suited for this environment?" The legends in new market wizards often had losing quarters, yet they never abandoned their core edge. They downsized, observed, and waited for the environment to shift back in their favor. One trader said, "I used to treat my strategy like a magic spell. When it didn't work, I thought the spell was broken. But strategies are just tools, and tools only work in the right context. Stop the endless hunt for the perfect system. Start mastering the one you already have." Self-sabotage is often disguised as the search for something better. The loss aversion trap, why we strangle winners and nurse losers. This is the most universal form of self-sabotage. You know it's wrong, yet you repeat it. Your brain is hardwired for survival, not for maximizing a P and L. Daniel Kahneman's Nobel research on loss aversion proved that humans feel the agony of loss twice as intensely as the joy of gain. Losing $1,000 hurts more than winning $1,000 feels good. This creates a lethal psychological anchor. When a winner pulls back, your brain screams, "Secure the profit before it vanishes." When a loser moves further against you, your brain whispers, "Hold on, surely it must bounce back." This isn't a personal failing. It is evolutionary programming. Your ancestors survived by avoiding loss, not by taking calculated risks. But in this arena, those survival instincts are your executioner. One pro trader shared, "I stopped fighting loss aversion. I started calling it out. Every time I wanted to close a winner early, I'd say, that's just my lizard brain talking." That awareness gave me the power to wait. Your emotions are data points, not instructions. Fear indicates vulnerability. Greed indicates overconfidence. Frustration indicates attachment. Winning traders aren't robots. They are hyper-aware humans who have learned to translate emotional noise into logical action. The perfectionism disease. When high standards become an anchor, you wait for the flawless setup. You overanalyze every candle. You demand 5-tier confirmation. And the move leaves without you. Again, perfectionism sounds like discipline, but in this game it is usually just cowardice masquerading as standards. The truth? There is no perfect trade. There is only probability. While you are paralyzed waiting for certainty, the professionals are taking 60% probability setups with disciplined risk. Perfectionist traders consistently underperform. They suffer from analysis paralysis. The fear of being wrong makes you incapable of being right. You hesitate, you miss the move, and that regret fuels the mistakes on your next trade. One trader confessed, "I wasn't being disciplined, I was hiding. I sought the perfect setup to avoid the discomfort of actually being in the market." The antidote: good enough is the standard. Elite traders take 3-star setups with 5-star risk management. They know that wealth is built on consistency, not a single perfect strike. Are you being selective, or are you just afraid? Selective traders execute when their criteria are met. Scared traders move the gold posts the moment an opportunity presents itself. The comparison poison, trading through the eyes of others. You see a 200% gain posted on social media, and suddenly your consistent 5% feels like a failure. You start chasing home runs. You increase your risk. You blow your account trying to match a highlight reel. Social media is a curated illusion. People post their trophies, never their graveyard. Your brain adopts a false baseline, believing that anything less than spectacular is a loss. But the market wizards prove that there is no universal path to millions. Some scalp for pennies, some hold for months. There's only your path. One pro noted, "I wasted 2 years trying to trade like my mentor and lost money every month. The moment I started trading like myself, I became profitable." Stop measuring your worth against someone else's filtered P and L. Measure yourself against your process. Did you follow your rules? Did you manage risk? That is the only scoreboard that matters. Once you make this shift, you stop sabotaging your own progress to chase someone else's shadow. The revenge trading death spiral. When pain becomes your strategy. You hit a loss, it hurts, you take another. Now you're agitated. A third loss hits, and something inside you snaps. The prefrontal cortex, your rational brain, shuts down. Your amygdala, the fear center, takes command. You aren't trading a plan anymore. You are trading your pain. You size up. You take garbage setups. You try to force the market to give back what it stole. This is the fastest way to turn a minor setback into a terminal disaster. Neuroscience confirms that consecutive losses literally make you less intelligent and more impulsive. I lost $3,000 on 3 trades, then revenge traded myself into a $15,000 hole, one trader admitted. The market didn't do that. I did. The solution is a circuit breaker, a mandatory rule. 2 losses in a row and you are done. You walk away, you reset. The version of you that exists after 2 losses is not fit to manage capital. You are no longer a trader, you are a victim, and victims get slaughtered. The isolation trap, the poison of silence. You fail again, you feel the shame, you hide it because admitting it feels like admitting defeat. You convince yourself you're the only one struggling, but every legend, every wizard, has felt like a fraud. Every one of them has considered quitting. The difference is they broke the silence. They found mentors. They joined communities. They stopped pretending. They realized that vulnerability is a prerequisite for growth. Self-sabotage thrives in the dark. When you isolate, your brain invents stories about how you are uniquely broken. The moment you share the struggle, those stories lose their power. You realize you aren't broken, you're just learning. Find your community. Don't fight these demons alone. The identity shift from saboteur to sovereign. Self-sabotage isn't a random glitch. It's a role you have accepted. But roles can be rewritten. Identities can be forged. Professional traders don't try to be disciplined. They are disciplined. It is part of who they are. I used to be a guy who cut winners. Now I am a guy who rides them. First, name your pattern. I exit early because I'm afraid of losing my small gain. Second, understand the why. I'm protecting my ego from the pain of being wrong. Third, decide who you are becoming. I am a trader who trusts the math and lets the edge play out. Act from that new identity, one trade at a time. You don't rise to the level of your goals. You fall to the level of your systems and your identity. The market knows who you are. It will reward your growth or punish your stagnation. Your next trade isn't about the money. It's a vote for the person you're becoming. You've seen the anatomy of the trap. Awareness is the first step, but action is the only cure. Think of the last trade you sabotaged. What was the pattern? Name it. Own it. Strip it of its power. The market isn't stopping you. You are. But the moment you realize that, the power shifts back to you. Make your next trade a decision about the silent executioner. Confronting the ego in trading. Your last trade was statistically perfect. Everything aligned exactly with your strategy. The entry was precise. Your risk-reward ratio was a disciplined 1-to-2. You remained absolutely loyal to your protocol. Then, without warning, the market reversed. You were stopped out. Now here is the definitive question. How did you react? Were you able to maintain a stoic calm, accepting this as an ordinary occurrence? Or did you succumb to those dark, familiar impulses you know are toxic? Did you feel a desperate internal urge to prove the market wrong? Did you feel the need to justify yourself, to prove you weren't mistaken? Did you want to scream that your intellect was superior and that you didn't deserve this? Do you know whose voice that is? That is your ego speaking. It is the silent saboteur, methodically destroying everything you have worked to build. It hijacks every edge you have gained, snatching it from your hand simply because its pride is wounded. It has zero regard for your financial well-being or the longevity of your trading career. The source of failure. Here is a truth that most traders live in a state of perpetual denial about. The inability to generate consistent profit rarely has anything to do with a flawed strategy. It isn't the fault of your indicators or your broker's spreads. It isn't the result of market manipulation, algorithms, or whales hunting your stops. The obstacle is you, specifically your ego. Your ego wants you to believe you're the exception to the rule in these markets. It whispers that in an environment where winners follow rules, you can somehow be exempt. It tells you that this time will be different. Every time you listen to it, you are feeding a monster. In reality, you are effectively transferring your wealth to traders who have mastered their own egos. Today, we confront the most dangerous adversary you will ever face. It isn't volatility, and it isn't even fear or greed. It is your ego, the invisible force that transforms winning systems into losing machines. It is the silent enemy that makes the smartest people do foolish things with real capital. By the end of this discussion, you will fully understand how your ego sabotages your career. More importantly, you will learn the exact steps to neutralize it before it incinerates your account. The intelligence trap. The story of Marcus. Let's begin with Marcus. Marcus was a man of immense intellect, holding a PhD in applied mathematics from MIT. He developed algorithmic models so sophisticated they would rival those of institutional quants. His backtest showed that even in the most catastrophic years, his models achieved 40% returns. The strategy was mathematically bulletproof and thoroughly researched. Then he started trading with real money. Within 6 months, Marcus blew through 3 separate accounts totaling $80,000. The failure wasn't in the math, it was in the execution. Every loss triggered a crisis of identity deep inside him. Because he defined himself by his intelligence, he could not accept being wrong in the face of the market. He would spend hours overanalyzing each loss, believing that thinking harder would solve the problem. But there was a fatal flaw. The more he analyzed, the more emotional he became. The more emotional he became, the worse his decisions got. This is the intelligence trap in its purest form. Marcus believed he could escape emotional reactions through pure logic. He treated trading like a chess match, assuming perfect rationality would lead to perfect outcomes. But markets are not chess games. They are psychological battlefields where emotional stability determines survival more than IQ. His ego whispered that he was smarter than the market and his analysis was superior. He assumed that deep research would eventually crack the code. But Marcus never understood that the market doesn't care about your degree or your effort. It doesn't care how many hours you spent on research. It only cares about one thing. Can you stay loyal to your plan while your ego is screaming at you to do the opposite? The 3 brutal paths of destruction. Most traders fail because the ego is a master of disguise. It comes with a different excuse every day, dressing emotional reactions in the garb of rationality. It destroys you in 3 distinct ways. First, the need to be right. Your ego views a losing trade as a personal failure. It ties your self-worth to a single outcome. If you win, you're a genius. If you lose, you're a disappointment. This is psychological poison. Think of a professional poker player. They know that losing a hand with pocket aces is just part of the game. They don't question their intelligence because of one hand. They understand they must make correct decisions based on probabilities over thousands of hands. But most traders cannot separate their identity from their trades. They take every market feedback personally. Imagine risking $100 to make $300. The trade goes against you. At the stop-loss level, your potential loss is $98. The price reaches $98.50, but you haven't placed your stop. Your ego kicks in. It'll reverse. I know this market. I've studied for hours. You move the stop. You tell yourself you're being flexible, but deep down you know you're on a path to disaster. You turn a $100 loss into a $300 catastrophe because you couldn't admit defeat. This cycle destroys more accounts than any market crash. The need to be right is Bunroot draining your pocket every day. Second, the illusion of control. The ego loathes uncertainty and desperately seeks control. This is why traders overanalyze and clutter their charts with indicators, seeking a certainty that doesn't exist. The liberating truth is this: you can control nothing in the market except your own actions. You don't control price, volatility, or global events. You only control your entry, exit, size, and reaction. Everything else is a narrative created by the ego to feel safe. When you say, "I know this stock will go up," you are lying. You have an opinion based on patterns, but you do not know. Please don't say you know. Don't impose that weight on yourself. Remind yourself that every possibility always exists. Support levels might work or they might not. You don't determine the outcome. Professionals think in probabilities, not predictions. They don't say, "This trade will win." They say, "This setup has a favorable probability, and I will take the bet knowing I can still lose." This subtle shift in language represents a massive leap in psychology. The professional has murdered the need for certainty. The amateur remains its slave. Third, the comparison trap. The ego is fueled by comparison. Social media exacerbates this, pushing traders out of the game by showcasing curated highlight reels. You see a $10,000 profit post, and suddenly your consistent $200 day feels like a failure. Your ego ignores the 50 losing days before that profit or the reckless leverage behind it. It only sees your inadequacy, forcing you to take unnecessary risks to catch up. You increase your size and take low-quality setups out of envy. Your ego wants the impressive result now. It seeks external validation of your talent. Professionals, however, only score themselves on execution. Did you follow the rules? Did you manage risk? That is the only scoreboard that matters. How to kill the ego. Radical acceptance. How do you kill your ego before it kills your account? You must achieve a radical acceptance of uncertainty. You must internalize at a bone-deep level that you cannot control market outcomes. You don't need more indicators. You need more acceptance. Markets move on collective emotion and institutional flows that no individual can fully grasp. When you accept this, magic happens. The need to be right disappears. A loss is no longer a personal attack. You stop measuring your worth by your win rate. You become emotionally neutral and independent. This is your superpower. Please internalize this. I do not know what the market will do next, and I do not need to know. I only need to execute my edge. Read this every day. Identity separation and the power of the journal. Your trading results are not a reflection of your intelligence or worth. A losing trade doesn't make you a fool. A winning trade doesn't make you a genius. These are simply outcomes. Professional traders develop identity discipline. They completely separate their self-worth from their results. They create a new identity. I am a disciplined executive of my trading plan. This identity is based on the process, not the money. Society teaches us that winners are valuable, but in trading that programming is fatal. To protect yourself, you must also use a journal. The ego thrives in the shadows. Journaling drags it into the light. Document your emotional state before, during, and after every trade. Over time, you will reveal your cycles. You will see that every deviation from the plan stems from a need to prove something or a fear of missing out. Once you recognize these patterns, you can consciously choose a different path. Strategic ignorance and reframing loss. The ego craves information, believing it leads to control. Instead, embrace strategic ignorance. Limit your information during trading hours. Ignore social media and the opinions of others. Information creates emotional noise. Plan your trade during quiet hours, then execute it in isolation. Don't check Twitter. Don't watch financial TV. Just execute your plan based on price action. Finally, reframe losses as tuition. Your ego sees a loss as a judgment. You must see it as the price of education. Every professional has lost millions collectively. Losses are the cost of doing business. When you lose, ask, what did this trade teach me? If you followed your rules, it was a good loss. If you violated your rules, it was an expensive but valuable lesson. The ultimate test, James's secret. How do you know if your ego is neutralized? Take a trade, follow your plan, and get stopped out. If you feel calm and ready for the next setup, you're on the right path. If you feel satisfied because your discipline was perfect despite the loss, you have arrived. The goal is to lose without taking emotional damage, to separate your soul from every individual outcome. Let's conclude with James. He made millions for a decade. His secret? I spent 5 years trying to be smarter than the market and lost. I spent the next year learning to be dumber, simply following rules without thinking I knew better. James killed his ego and became unstoppable. Your ego is not your protector. It is your executioner. It makes you emotional, reactive, and unprofitable. Kill it before it kills your account. The market only cares about one thing. Can you execute your plan while your ego is screaming at you to break the rules? The achievement-oriented paradox. Here is an undeniable reality that will deeply unsettle any achievement-oriented individual. The more aggressively you work at trading, the more rapidly you will incinerate your capital. I anticipate your skepticism. To most, hard work is the fundamental pillar of success in every endeavor, the cornerstone of mastery and achievement. Yet the market views that belief with mockery before systematically seizing your funds. What remains undisclosed to beginners is that the market does not reward sweat equity. It is indifferent to your hustle and offers no consolation prizes for excessive screen time. The market compensates exactly one thing: being right at the precise moment with the correct risk parameters. That is the entirety of the game. The brutal irony is that by attempting to force success through traditional hard work, you drive the moment of profitability further away. A contrast of two methodologies. Consider the following portraits of two traders. You may find your own reflection in one of them. Trader 1 rises at 5 a.m. for exhaustive pre-market analysis. Fueled by caffeine and the glow of 3 monitors, he scans 50 charts, scrutinizes economic calendars, and monitors social media feeds. He reviews a dozen indicators and fills notebooks with observations. By 9:30 a.m., he is in a position, followed by another at 10:15 and a third at 11. By the closing bell, he has executed 8 trades. He feels productive and alive, convinced he has worked hard. His account, however, is down 4%. Trader 2 wakes at 8 a.m. and opens a single chart. Noticing his specific setup is absent, he closes his laptop and heads to the gym. He returns at 2 p.m., sees the setup still hasn't materialized, and takes 0 trades. To an observer, he appears lethargic and uncommitted. Yet his account remains unchanged, which, in the arena of trading, constitutes a win. In this field, the absence of action is often the most sophisticated expression of skill. Why the standard formula inverts, most ambitious people struggle to accept this. We are conditioned to believe that more hours and higher output lead to superior results. This formula holds true in academia, sports, and traditional business. However, trading is the rare environment where this logic doesn't just fail, it inverts. Here, more results in less. Effort becomes interference, and hard work manifests as self-sabotage. Until you grasp this, the market will continue to drain you while you wonder where your dedication went wrong. Let us dismantle the lie and examine how hard work kills traders, not because effort is worthless, but because it is being misapplied in destructive ways. 1. The overtrading trap. When one decides to work hard at trading, it usually manifests as hyperactivity, taking more trades, hunting for more opportunities, and staying glued to the screen. It feels productive, but the market does not reward participation. Taking 10 trades does not make you 10 times more likely to profit than taking 1. If only 2 of those setups were high probability, you simply gave yourself 8 extra opportunities to lose money. By being more active, you systematically erode your win rate while inflating your exposure to risk. A surgeon does not improve by performing unnecessary operations. A sniper does not gain accuracy by shooting at every shadow. Yet, when wired to believe effort equals results, sitting still feels like failure. You click, you enter, and you lose because you confuse busy work with profitable work. Sitting on your hands is actually the highest form of trading discipline. 2. Analysis, paralysis. The second way hard work destroys you is through over-analysis. You see a setup, but because you've been studying hard, you feel compelled to check 50 different variables. You scrutinize RSI, MACD, Fibonacci levels, and institutional order flow across multiple time frames. By the time your analysis is complete, one of 3 things happens. The move leaves without you. You talk yourself out of a winner because one minor indicator disagreed, or you work so hard that you find data to justify a terrible trade. Bruce Lee famously feared the man who practiced one kick 10,000 times, not 10,000 kicks once. The master of one simple strategy will always dismantle the hard worker who has a surface-level grasp of 50. Complexity is a disease disguised as sophistication. The more you know, the harder it becomes to act. 3. Emotional exhaustion. The third killer is the most insidious: emotional burnout. Spending 12 hours reacting to every tick of the price action puts your nervous system in a state of hypervigilance. Your brain is not designed to process this level of sustained intensity without fracturing. Soon, you are making decisions from a state of total depletion. Your discipline evaporates and your system becomes merely a suggestion. Trading while emotionally drained is like driving intoxicated. Your judgment fails and you see patterns that do not exist. One clear-headed decision made after a full night's rest is worth more than 50 decisions made during the 11th hour of a screen marathon. The best traders I know actually work less than everyone else because they realize their mental clarity is their primary edge. Their emotional stability is their alpha. Redefining what work actually means. If traditional hustle is poison, what does the market actually reward? It rewards 3 specific things: a clear system, unwavering discipline, and ruthless patience. The system. The real work isn't collecting strategies, it's refining one and following it with absolute consistency. This involves establishing objective, binary criteria for entry, exit, and position sizing. Once the rules are set, the work of strategy development is done. The discipline. This is where 95% of traders fail. The real work is following your system when it's boring and frustrating. The discipline to do nothing when there is no signal is worth more than any technical skill. This is psychological labor, and it is exponentially harder than staring at a chart. The patience. As Warren Buffett noted, the market transfers wealth from the impatient to the patient. A hunter doesn't shoot at every rustling bush. They wait for the perfect shot. The best traders might take fewer than 5 trades a month, but they trade with size and conviction because they waited. The invisible work of self-awareness. There is hard work in trading, but it is invisible. It is the work of understanding your own psychology. Most spend hundreds of hours on technicals and 30 minutes on themselves. The real work is asking, what triggers my impulses? How does my ego affect my sizing? This requires journaling and brutal introspection. The market isn't your opponent. You are. Every broken rule and revenge trade is the instance of you fighting yourself. Until you do the invisible work of mastering your internal patterns, you will keep repeating the same failures regardless of how many hours you put in. Why the best traders look like coward society teaches us that winners are aggressive and bold. In trading, the opposite is true. The masters look like cowards. They don't bet the farm, and they rarely trade. What looks like cowardice is actually mastery. Survival is the goal, and survival requires treating the market as if it is always one trade away from destroying you. The patient trader who protects their capital is far more dangerous than the hyperactive one who throws wild punches. Real strength is the control to say no to 99 mediocre opportunities, so you can say yes to the one that actually matters. The art of subtraction. Trading is an art of subtraction. Success comes from removing unnecessary indicators, emotional reactions, and the need to be right. Every instinct says, do more, but the market demands you do less. Imagine a calm lake reflecting the sky. That is a clear mind. Frantically stirring the water to be productive only distorts the reflection. Clarity, not effort, is what generates profit. When trading feels exciting or like hard work, you are likely doing it wrong. When it feels boring, systematic, and like simply executing a checklist, you are doing it right. The shift from output to process. To succeed, you must redefine your work ethic from output to process. In most jobs, more sales equals more success. In trading, following your process is a win, even if the trade loses money. You are no longer working for immediate results. You are working for long-term consistency. Mastering one setup and executing it with 100% fidelity 100 times is deep work. It is harder than jumping from strategy to strategy, but it is what creates wealth. The final truth: hard work, the wrong kind, destroys your account. The wrong effort is over-trading to feel productive and over-analyzing to feel smart. The right effort is following your system religiously, cultivating patience and protecting your mental state as your most valuable asset. If you have been grinding harder while results get worse, this is your wake-up call. The market doesn't want you to hustle. It wants you to be still. It wants you to be precise. The moment you stop confusing activity with progress is the moment you stop being the trader who works the hardest and start being the trader who wins. I will maintain the exact refined prose from our previous exchange while breaking the text into even smaller, more granular segments to ensure maximum readability and impact. The myth of technical superiority. An overwhelming 95% of market participants find trading to be an insurmountable challenge. They exhaust their capital, surrender to frustration, and eventually exit the arena altogether. They label the system as rigged, convinced that the market is a sentient entity designed specifically to sabotage them. They are certain that predatory algorithms are hunting their stop losses. They project blame onto every external variable while ignoring the solitary factor actually orchestrating their downfall. Meanwhile, an elite 5% find the process entirely obvious, almost mundane. To them, it is systematic, predictable, and bordering on boring. They operate in the same markets, look at the same charts, and have the same 24 hours in a day. The Great Divergence. What is the defining difference? It is not raw intelligence. I have witnessed some of the most intellectually gifted individuals, PhDs in mathematics, world-class engineers and surgeons, have their accounts systematically dismantled by the market. It is not a matter of starting capital. Whether you begin with $100 or $100,000, the failure rate remains remarkably consistent. Nor is it a lack of information. We all consume the same data feeds and witness the same headlines. The distinction is fundamental. The 95% are engaged in a frantic war. The 5% are participating in a game they have already won. I am going to reveal exactly why you are making this harder than necessary, and how the elite minority transitioned into a state of boredom through clarity. A tale of two philosophies, David versus Sarah. Consider David, a brilliant software engineer. He approached trading as a logic puzzle to be solved through data optimization. He didn't just use indicators, he lived by them. His charts were cluttered with 47 different overlays, moving averages, RSI, Fibonacci, and order flow matrices. His screen resembled a chaotic light show. Every morning he spent 3 hours in deep analysis, drowning in sentiment data and institutional reports. He believed more data equaled a better edge. After 18 months and $65,000 in losses, David realized he hadn't mastered the market. He had simply made it impossibly complex. Then there is Sarah, a former casino dealer with no formal financial education. Her background taught her one singular truth. The house wins because it possesses a mathematical edge and executes it with zero emotion. Sarah's system consisted of just 3 rules. Trade only during specific high-probability hours. Risk exactly 1% per trade. Exit at predetermined levels, win or lose. She avoided indicator soup and ignored economic noise. After 18 months, her account had grown by 42%. She wasn't smarter than David. She was just more committed to simplicity. Why trading? Violates your life? Lessons. The 95% gravitate toward complexity, while the 5% embrace the obvious. But why? Trading is difficult because it contradicts everything society teaches you about success. In the real world, more effort and more study lead to higher grades and better salaries. In trading, that formula is inverted. More analysis leads to paralysis. More trades lead to smaller balances. More information leads to total confusion. This environment shatters your mental operating system because it rewards behaviors that feel lazy or counterintuitive in any other career. 1. The uncertainty paradox. Every traditional job provides structure, tasks, procedures, and a predictable paycheck. Trading offers zero structure. You have total autonomy over when to enter, how much to risk, and how long to hold. Your brain abhors this lack of structure. It craves certainty like oxygen. To compensate, you add indicators, hoping to find a combination that predicts the future. You hunt for the Holy Grail, a system that never loses. This makes trading impossible because you're trying to capture certainty in a realm built entirely on uncertainty. It is like trying to grip smoke. The harder you squeeze, the more it eludes you. The 5% have accepted that they cannot predict the next tick, and they realize they don't have to. 2. The instant feedback trap. In most fields, feedback is delayed, providing emotional distance. In trading, feedback is immediate and visceral. 5 seconds after you click buy, you are either gaining or losing wealth. This instant loop hijacks your lizard brain, triggering survival instincts meant for physical threats. Every tick against you feels like a personal assault. You begin making emotional decisions like widening a stop loss and tell yourself it's logic. In reality, it's just your brain trying to avoid the pain of being wrong. The 5% view each trade as meaningless noise in a large sample set. They have developed the distance to see that short-term results are random, while long-term execution is everything. 3. Complexity addiction. Your brain is actively sabotaging you by making you crave complexity. Why? Because complexity feels like progress. Learning a new indicator feels productive, and watching hours of analysis feels like preparation. However, this is just consumption disguised as work. The market does not reward your education, it rewards your execution. It rewards boring repetition. David was addicted to information. Every loss convinced him he needed more data. Sarah understood that simplicity is a strength to be weaponized. Her edge was simple by design, ensuring she could actually execute it under pressure. 4. Outcome obsession. If you check your balance 14 times a day, you are suffering from outcome obsession. You measure your worth by today's profit and loss statement. This is a fatal error because you control nothing regarding outcomes. You cannot control market direction or whether a specific setup works this time. You control only one thing, whether you adhered to your rules. The 95% measure success by dollars made, the 5% measure success by rules followed. If Sarah took a loss but followed her exit plan perfectly, she considered the day a success. This shift from money focus to process focus is what builds consistent equity curves. 5. Information overload. Consumption of news, newsletters, and social media analysts creates a paralyzing amount of noise. Past a certain point, more information does not improve your decisions, it degrades them. Every analysis is just an opinion, and when you consume too many conflicting views, you freeze. This is analysis paralysis. The elite 5% practice strategic ignorance. They deliberately ignore anything that isn't their specific signal. Sarah didn't read reports or follow experts. She had her rules, and everything else was noise. Focus is infinitely more valuable than information. The shift from impossible to obvious. The transition to the top 5% isn't about learning more. It's about unlearning. Shift 1. Embrace uncertainty. Stop trying to be a prophet and start being a reactor. Professional traders don't say the market will go up. They say this setup has a high probability. That change in language represents a massive psychological leap from prediction to probability. Shift 2. Process over profit. Define success by your checklist, not your bank account. If you followed your entry, sizing, and exit rules, you won the day regardless of the financial outcome. This removes the emotional roller coaster and grounds you in a repeatable routine. Shift 3. Simplify ruthlessly. Remove 90% of what is on your screen. One strategy, one time frame, and one market mastered is better than 10 strategies dabbled in. Complexity is just confusion in a fancy outfit. Shift 4. Strategic ignorance. Guard your focus. Your edge is found in your system, not in the opinions of others. Limiting your inputs will feel like you're missing out, but in reality you are gaining focus. Shift 5. Patience as a strategy. The 5% spend most of their time waiting. They aren't bored, they are hunting. Patience is not passive, it is the active willingness to wait for your edge rather than manufacturing trades to feel productive. The case for selective trading. Michael, a former hyperactive day trader, used to take 30 trades a day for stagnant results. He radically limited himself to 3 trades maximum. On days when no setup appeared, he took 0. His brain screamed that he was wasting time, but his win rate soared from 42% to 61%. His winners grew larger because he was only taking the absolute best setups. He didn't change the market, he just stopped forcing trades. Trading isn't about being busy, it's about being selective. Preserve your mental energy for the moments that truly matter. The identity shift and the boring truth. The elite to 5% don't identify as profit chasers. They are rule executors. This makes them psychologically bulletproof. A loss doesn't damage their ego because they didn't fail at their job. They followed the rules and the market simply didn't cooperate. When you stop chasing money and start executing rules, the money follows as a byproduct. But here is the boring truth. Professional trading is remarkably dull. It is hours of waiting interrupted by moments of focused execution. If your trading feels like a high-stakes roller coaster, you are doing it wrong. Boredom is the price of consistency, and consistency is the price of wealth. Final truth. Flow. Don't fight. Trading is only impossible when you fight its nature. It becomes obvious the moment you stop demanding certainty from a world of probability. David never made the shift. He quit and blamed the rigged system, never realizing he was fighting the wrong war. Sarah continues to trade boringly and consistently. It's just a routine for her, like brushing her teeth. That's the sign you've made it. When trading stops being a dramatic battle and becomes a boring routine, impossible becomes obvious. You have a choice. Follow the 95% into complexity or join the 5% through simplicity. The market will keep moving regardless of your choice. The question is, will you still be there to capitalize on it, or will you be just another statistic? Stop fighting. Kill the complexity. Kill the need for certainty. Start flowing. He just secured a $40,000 profit in a single transaction. His friend, watching intensely over his shoulder, urges him, "Bro, the price is skyrocketing. Let it ride. You could easily turn this into $100,000. Ignoring the noise, the trader closes his position exactly at his predetermined target. He banks the $40,000 and exits the market. The friend is absolutely livid. "Why on earth did you close? The price jumped another $30,000 after you sold. You're such a coward." The millionaire trader simply smiles. "Exactly," he replies. This is the story of why the millionaire trader mindset often resembles cowardice, and why that very cowardice just earned him his 4th million. The illusion of the brave trader. Everyone craves the millionaire trader mindset. People associate it with unwavering confidence, intense conviction, and the balls to risk big and win bigger. Most believe it means having the courage to hold through massive drawdowns. You think that's what a millionaire mindset looks like? You're wrong. Dead wrong. I've spent years studying actual millionaire traders, not the ones hawking expensive courses or flexing on Instagram, but the real quiet professionals. These are the individuals with $2 million accounts who drive modest Hondas and live in unassuming houses. What I discovered is that they all appear to be cowards. They bank small wins while others swing for the fences. They flee from losses while others stay strong. They dodge exciting volatile trades while others hunt them. They risk minuscule amounts while others go big or go home. To an outsider, their actions look weak, timid, and cowardly. Yet, that is precisely why they are wealthy. Survivors versus warriors. While brave traders blow up their accounts trying to prove they are fearless, the cowardly traders survive. Survivors are the only ones who get to experience compounding, and those who compound eventually become millionaires. The graveyard of trading is littered with brave warriors, while the Forbes list is populated by disciplined cowards. In this profession, the most profitable thing you can do is be afraid. Let's look at the numbers. Mike versus Lisa, the cost of bravery. Meet Mike. He has traded euros to US dollars for 3 years, read every book, and mastered technical analysis. Mike's only flaw is his refusal to be a coward. When price hits his 2-to-1 risk-reward target, his ego screams, "Don't be a weakling, let it run. This is the big one." He holds. Occasionally, he feels like a genius when price climbs higher. But more often than not, the market reverses. His $2,000 winner evaporates into a $500 gain or a $300 loss. Out of 47 trades this year, Mike caught only 2, big ones, while 45 hit his stop or reversed. His account is down 23%. Now meet Lisa. She trades the same market and the same setups, but Lisa is a coward. Every time price hits her 2-to-1 target, she closes the trade instantly. No hesitation, no what if. Her friends mock her for leaving money on the table, calling her too timid to make real wealth. Lisa doesn't argue, she just smiles and executes. This year, Lisa took 89 trades with a win rate of only 38%. However, because her wins were always 2-to-1 and her losses were always 1, the math worked in her favor. She earned a 26% return, while brave Mike lost nearly a quarter of his capital. The brutal truth about markets. Markets do not reward bravery, they reward consistency. Holding past your target isn't brave, it's greedy. A $2,000 win in the bank is worth infinitely more than a $5,000 win in your imagination. The broke trader gambles on hope. The millionaire executes a system. The coward takes small wins, compounds them, and eventually becomes the millionaire. David versus Sarah. The trap of holding strong. David prides himself on mental toughness. When a trade goes against him, he refuses to run like a coward. He believes in his analysis and treats pain as a test of discipline. This strength has destroyed 4 of his accounts because he confuses courage with stupidity. When he's down 2%, he holds. At 5%, he averages down to get a better price. By the time he's down 12%, he's paralyzed by the size of the loss and resorts to prayer. Eventually, these 12% losses turn into 35% drawdowns, or margin calls. David has lost $87,000 in 2 years. Sarah, meanwhile, is a coward. If a trade moves 1% against her, she exits immediately. No, let's see if it bounces. Her friends call her weak for getting shaken out by temporary noise. Sarah doesn't care. Even after 143 stop-outs this year, her total drawdown is only 18% because she never lets a loss grow. She is still in the game. David, however, is at 0%. Capital deployment and survival. A study in the Journal of Finance found that traders who cut losses quickly had a 67% chance of being profitable over a decade. Those who gave trades room to breathe had only a 9% chance. The millionaire knows you cannot compound if you are dead. Holding a losing position ties up capital that could be used for the next opportunity. While David is bleeding out in one bad trade, Sarah has moved on to 3 new ones that put her back in the green. Richard and the allure of excitement. It's November 2021. Bitcoin is exploding and Dogecoin is up 400%. The world is obsessed with crypto. Richard, however, continues to trade boring Forex pairs like EUR/USD, just as he has for 9 years. His friends are making $50,000 a week on Shiba Inu and calling him a coward for playing it safe. Richard stays in his lane. He sees the volatility as irrational gambling. In 2022, the crypto market crashes and his friends lose everything. Their $50,000 wins turn into $200,000 losses. Richard, the coward, quietly made $127,000 trading his boring strategy. By 2024, his total profits crossed $890,000. Exciting trades are where money goes to die. Boring trades are where capital goes to compound. When everyone is excited, everyone is usually wrong. The millionaire trader doesn't trade what's once in a lifetime. They trade the same boring setup 1,000 times. Marcus versus Jennifer. The math of position sizing. Marcus believes in high conviction betting. He risks 5% to 8% per trade, thinking he'll get rich faster. He forgets about variance. A string of 7 losses, which is statistically normal, drops his account by 30%, requiring a 43% gain just to break even. Marcus has blown up 3 times, losing $100,000 to $15,000. Jennifer is a coward who risks a tiny 0.3% per trade. Her friends laugh, saying a $300 profit is pointless. Jennifer ignores them and lets the math work. With a 45% win rate and a 2-to-1 reward, she consistently grows her account. After 5 years, she has more than doubled her capital. By year 10, her $100,000 account hits $432,194. Small position sizes feel cowardly, but they are intelligent. Survival isn't about the size of your wins, it's about the size of your losses. Alex versus Daniel, the profitability of ignorance. Alex has an opinion on everything: gold, Tesla, Bitcoin, inflation. He feels confident because he knows the market. But Alex is down 31% because he trades his ego, not the price. Daniel has traded for 12 years and only knows one thing: a specific price action setup on GBP/JPY. If you ask him about gold or crypto, he says, I don't know. His friends think he's an idiot, yet that one thing has earned him 1.14